Okay, so welcome to Chapter 8, another really fun chapter for me because it's RSPs today. I'm going to make a note before I share my screen. I want you to notice for next class, we will be taking up self-test 3. So make sure you have self-test 3 done. That's done in Inkling like we did before. We're going to do the polls at the beginning of class, and we'll do the review problems. The other thing I want to let you know is RSPs are difficult. We're going to touch on them in this chapter, and then we're going to come back to it again and make them a little bit more complicated in a later chapter as well. I believe it's chapter 12. Once that's done, I'm going to send you something that I do for my students, which is a 2-page summary of everything you need to know about RSPs in one place. It's not enough to give you the answers, but it's enough to give you the basic rules all in one place that you can look at. And then if you have an issue with one of them, you can dig into the textbook for more information. I found that really helpful for me. I did it for myself when I was studying. I have offered this to all my students. So I will be sending that out when we finish the RRSP chapter. Just as a guide, it's not needed, it's not required, but you might find it helpful. Okay. So let's jump into RRSPs, the beginning of RRSPs. We're doing the easy stuff today, and we're going to make it a little trickier after this. So I will say, make sure you really know Chapter 8 before we get to the more complicated chapter on RRSPs, because if you don't know this part of it, that's just going to be confusing. Okay, what are RRSPs? They are a type of savings plan. And in order for investment companies to offer an RSP, they have to meet a whole bunch of rules. So the CRA wants people to save for their retirement because they don't want to have to be paying pensioners out of their own government programs. They would prefer that you put money aside. So to encourage that, they have what are called RSPs. If you put money into an RSP, you get a deduction on your tax return now, and then you pay tax when you take the money out. So it encourages you to put that money aside and to leave it in. The goal is to leave it in. They're registered because there are rules that they have to follow that say they can't put it in something really speculative. So you're going to find that there are a lot of really good investments inside an RSP. You can make some pretty decent money if you leave it in long enough, but you're not going to be doing crazy cryptocurrency things inside an RSP. They want it to be something stable enough that hopefully if you put your money in when you're young, when you finally retire, there will be more money in it than there was when you put it in. The important thing to know is the growth is tax-free while it's still in the plan, but when you take the money out, you pay tax on everything. So once you take money out of an RSP, it is always taxed when it comes out of the RSP. With a little star, we're going to talk about a couple of scenarios today that will let you essentially borrow from your RSP that you have to pay back in, and that's the only way you can take money out without paying tax on it right away. Okay? What you get is a receipt. So if you buy an RSP, the bank will give you a receipt. And if you have that receipt, bring it in when you do your taxes, and we will decide how to deal with that receipt when we do your taxes. You can put money into an RSP for yourself, which is an own plan, or you can buy an RSP for your spouse. If you buy an RSP for your spouse, who does the money belong to? Your spouse. They can do whatever they want with it. We'll talk about that in more detail when we get to early spousal withdrawals and how frustrating it is for someone who is putting money into an RSP for a spouse, and then the spouse is taking the money out and spending it. That can create problems, but you have no say in it because it is your spouse's money. We will talk today about reasons why you might want to put money into a spousal plan. There are a couple of reasons for it. One, you might have a really good pension at work and your spouse might not, and you might want to, and this is financial advice, not necessarily tax advice, you might want your spouse to have income when they retire, which would be RSP income for the spouse. Or you might want to, because of an age difference between you and your spouse, it can, in some circumstances, let you continue to get deductions for putting money into RSPs, even when you're too old to contribute to them. So we'll see that example today. But you have a choice where you're going to put it in. Once you put it in, that's who owns the money. If you put it in a plan for yourself, it's yours. If you put it in a plan for a spouse, the money belongs to your spouse. Okay, we're going to do a little activity here. Let's see if you have been paying attention. So what I would like you to do is I'm going to annotate in just a minute, and you're going to tell me which of the statements are correct. Contributions are taxed when you put the money in, taxed when you take the money out, or never taxed. And growth is taxed annually as it's earned, taxed when you take the money out, or never taxed. Let's see what you think. So put a mark or circle, or otherwise let me know what you think the right answer is. Okay, lots of people agreeing. I'd like to see a few more participating. We've got a big class today. Okay, and I will say you all did a really good job. RSPs are taxed when you take the money out. They're tax-free while they're in there. You get a deduction, but they will eventually be taxed. And the growth is taxed at the end when you take the money out. Those are the correct answers. So I want you to think about what that means. If you put it into an RSP, it will be taxed eventually. What advice, now that you know that, would you give to someone who got a $10,000 inheritance? What would you suggest they do with that inheritance? Or what would you suggest they not do with that inheritance? They should spend it. They should invest it in a tax-free savings account, maybe. They should buy a nice other type of investment with it. Do not put it in an RSP, because if you put it in an RSP, what happens? You take money that was tax-free and you make it taxable. Something to think about. We'll come back to that. I'm pretty sure that there's an example in here. And Karina, very good. You will use up your deduction room at the same time. So we're going to talk about deduction room. But when you put money into an RSP, you can't put as much as you want. You can only put what they let you. And once you take it out, you use up the room. Good. So we're all understanding how RSPs are working. When you put the money in, you get a deduction, so you don't pay tax on that money now. But when you take it out, you will pay tax on it. And when it's growing, you won't pay tax on it while it's growing, while it's earning interest and going up in value. But when you take it out, you will pay tax on that as well. Okay. So how do we do deductions on the return? We need a Schedule 7. Schedule 7 has a number of sections on it, so I want to spend a little bit of time talking about that. Okay. And I'm going to do that actually looking at a Schedule 7 as well. So I'm going to go to my tax package. I'm going to find a Schedule 7. And let's take a look at one together. We're going to come back to this probably a couple of times today. The first thing I'm going to say is there are a lot of helpful notes, again, in terms of what you can put on a return. What do you notice about the contribution room? So when do we put RSPs on a return? What months are we looking at when we're putting RSPs on a return? March, December of this year, and January, February of next year. So everything on a tax return happens from January to December, except for RSPs, which happens from March to March. Why do they do that? Why do they say you have until March 1st to put money into an RSP? Well, because you're not going to know how much you need as a deduction until you do your taxes. And you can't do your taxes until you get your tax slips at the end of the year. So the year finishes, then you know how much income you made, then you can do what I recommend for my clients. If you know you want to buy RSPs, but you don't know how much you want to buy, you can come into a tax office in January or February with your tax slips, whatever information you have, do a trial balance and figure out how much money you need to put into RSPs to be beneficial to you, either to drop you down a tax bracket, to give you the refund you're looking for, all of those things. Because remember, a deduction comes off the top portion. So one thing we like to do is give people enough RSPs to take them from one tax bracket down into the next tax bracket level, because they're going to save the most RSP money possible. Think about it this way. If you're in the top tax bracket and you take out a $100 RSP, how much tax are you saving? So what is your deduction going to be worth to you? You've got a $100 RSP deduction and you're in the top tax bracket. What is that worth to you now? Top tax bracket is 33%. What's the value of that deduction? $33, right? So you've taken money that would have been taxed and you've saved $33. If when you retire, you're in the lowest tax bracket, how much tax will you pay on that money? $15. So now you have saved tax. So if you can take money off from a high tax bracket, and if when they retire they're in a lower tax bracket, you're not just delaying when they pay the tax. They're going to pay some tax eventually, but you're actually saving tax. You're paying less tax for the same dollars that you would have paid. So that is the value of an RSP, is not only the higher up you are, the more deduction you get, but also sometimes if you can take the deduction off when you're in a high tax bracket, if you retire and you have a lower income when you retire, you're actually saving money. Now, let's put the reverse. What happens if you have a client who's in the lowest tax bracket and they take out an RSP now? They're in the lowest tax bracket, they get a deduction of $15. So they're going to save $15 tax today. Now they get a big job, they get a really nice job. Now they're in, let's say, the second tax bracket, 20.5%, and they need some money urgently. If they need that money urgently and they take it out while they're in that tax bracket, what's happened? Now they're going to pay $20.50. So the goal for RSPs is put it in when you're in a high tax bracket and leave it in until later. And Leon, yes, tax rates may rise in the future, but they could go down. Some tax rates have gone down. So we've seen, in my years of doing tax, I've seen a reduction in several of the tax rates and then an addition of a new tax bracket in the top. So we can't plan everything perfectly because we don't know what's going to happen in the future. But the goal of RRSPs and the best tax planning strategy we have is to try to put it in when you're in one of the higher tax brackets and try to take it out when you're in one of the lower ones. Okay? And because we need to know what our income is to decide how much we need to drop us down a tax bracket, we have this extra buffer. So my next question for you is, when will you put on a return an RSP receipt that's dated January of 2021? Which tax return does that tax receipt have to go on if you want to claim it? Has to go on 2020. I cannot claim it now. It has to go on 2020. If your client missed it, so your client has never reported RSPs before, they've never claimed deductions for RSPs before, and they're coming into you with receipts, and one of them says January 2021, what can you do to get them that deduction? We can't put it on 2021. We can do an adjustment. In fact, you have to do an adjustment if you want to use it. So it's not lost, it's not gone forever, but it's not going to be on this return. All right, so we have a couple of things on this page I want you to notice. You're going to put your contributions in 2 chunks. You usually get 2 receipts. You'll get 1 receipt for March to December and 1 receipt for January, March. That being said, it kind of depends on what your client does. So what I often see is my clients will bring me 1 receipt for March to December, but they're on a regular contribution plan. So maybe they put, $100 in every 2 weeks, and it comes directly out of their work. They've got it set up through a financial advisor, automatic payment plans. What they'll usually do is they'll give me 1 receipt for March to December because it's been summarized, but then the January, February ones, the company hasn't had time to send out a final one, so they'll bring in 4 or 5 or 6 or 7 slips, however many, and I will have to add them all together, make sure I'm including the right ones. You have to be very careful that it is to March 1st, so it is the day after the last day of February. Sometimes it's fussy because they might get posted on a certain date, but you want to see the receipt to March 1st, and you're going to add them all together and put them in here. Be careful as well that you're not duplicating, so you might see them, again, you might have a couple of individual receipts. If they go in and they buy RSPs a few times in the year, they'll get a receipt every time they buy it, but they'll get a summary receipt at the end of the year. Make sure you're not doubling it. That if they have 4 receipts, make sure that it's 4 individual receipts. Add them together, take the March to December, put it on line 2, take the January, February of this year, current year, put it on line 3. If they had contributions that they reported in previous years but did not deduct for one reason or another, maybe they didn't because they chose to save it, they made the RSP contributions but they didn't need it so they didn't use it, or maybe they weren't allowed to use it because of the limits, they will have what's called undeducted contributions. And that's going to go here. And where will we get undeducted contributions from? How do we find out about undeducted contributions? From previous returns, from the notice of assessment. These will be carried forward in the notice of assessment. It will say RSP limit is this, undeducted contributions is this. And when you do your represent a client, you'll have all of your RSP information there. You can see what they claimed in previous years, what they haven't used, and your limits as well. So you're going to put the undeducted contributions. That's things that were contributed prior to this tax year and not deducted. And you're going to have things that were contributed this year from March to March. And then you're going to have your total contributions. Okay? All of this comes from receipts. So far, so good. We're going to talk about repayments. So we're going to come back to this in a minute. Then we have our RSP deduction, which is what you're allowed to contribute. So we need to know your RSP limit. We're going to talk about RSP limits today. It's going to go here. We can decide how much we're going to deduct. We're going to talk about transfers in a later class. Transfers are difficult, but common. So we'll cover that in the more advanced section. And essentially what you can deduct is what you put in up to your maximum limit. You don't have to deduct it all. You can choose. So you can decide what you want to deduct. What you want to deduct goes on line 18. And then if your limit allows it, that's what you're going to put. And anything you don't deduct, but you did buy a receipt for, you're going to get a contribution available to carry forward. Okay? And we'll talk about Part E at the end. So we're going to talk about Part E today, but we'll do that after. This is your Schedule 7 in a nutshell. Okay. If you want to report RSPs so that you can deduct them, either deduct them now or deduct them in the future, you must fill out a Schedule 7. All right, let's go back to our slides. So what we have, contributions come first, any repayments come second, calculating how much we can deduct and what we're going to deduct this year is Part C. Carry forward is Part D. Withdrawals under the Homebuyer Plan and Lifelong Learning Plan, which we're going to talk about today, is Part E. And then Part F, we're not really going to talk about, except I'll mention it exists in the book. There is a special rule for contributing to an amateur athlete trust. I've never had one happen, but theoretically it could happen. If it did, I would go back to my textbook and I would learn about it. Okay, so with RSPs, I'm going to start using some terminology that you need to know. When you are putting money in an RSP, there are different roles. So the person who puts the money into the RSP, we call that person the contributor. I want you to think of this as having different hats. One hat is called the contributor hat, and one hat is the annuitant hat. You might wear both hats, or you might wear one and somebody else will wear the other one. And that becomes very important because the rules for how we put money into RSPs, some rules are dependent on the contributor, who the contributor is, and some rules are dependent on who the annuitant is. So if you're putting money in, you're the contributor. If you're the person who can take the money out, you're the annuitant. Okay? If you put money in your own RSP, you are both the contributor and the annuitant. So you're wearing both hats at the same time. But if you put it in a spousal plan, you're the contributor and your spouse is the annuitant. Okay? The thing that mixes people up is the person who reports the deduction is the contributor. So if I put money into an RSP in my spouse's name, if I give that money to my spouse and put it in an RSP for them, I have to claim the deduction. Even though the person who owns the money and can take the money out is my spouse, the deduction has to go on my return. So clients get very confused about this. They get mixed up about this all the time. Okay? How much can you contribute? Anything that you've put in from March 2nd, 2021 to March 1st, 2022 will be reported on a 2021 tax return. You can put money into your own plan until the end of the year in which you turn 71. So in the year you turn 71, you're 70 for a period of time, then you turn 71. You have until the end of that year to put money into an RSP for yourself, and you can still claim it as a deduction on your return. What's important, though, is the age is tied to the annuitant. So what you might do is you might be over 71, but your spouse might be under. And in that scenario, you can still put money into your spouse's RSP as long as they are under 71, or this is the year in which they turn 71. Okay? In that case, you can put money in your spouse's RSP. You are going to claim the deduction. The deduction is going to go on your tax return. It's yours. The RSP, however, belongs to your spouse. So the age is tied to the annuitant. Are there any questions about how that works? Okay, let's test it out. Oh, before I test it out, I want to talk about limit because that's important. You can't put in as much as you want. Annuitant can borrow money. They're not borrowing money. It's their money. They've been given money. But if you put it in the spouse's plan, the person who can take the money out is the annuitant. You can't take the money out and get it back. Once you put it in the spousal plan, it belongs to your spouse. It's theirs. Okay. So that's an excellent question. Okay. So you can't put it in as much as you want because if you could, rich people would do this all the time. Very, very rich people would be very happy if there was no limit to what they could put into an RSP because they would be sheltering all kinds of money forever. So there is a limit. The way the limit works is it builds up over time as you have essentially earned income. So in order to have earned income to generate an RSP room, you have to file tax returns. Once you file tax returns, the limit will build and build and build. And then there's a limit to every year how much it will go up. And if you never put money into your RSP, that limit just exists. Once you put money in, it starts to fill up the room. And the thing to remember about RSPs is it will fill up the room in one direction only. So you have to create room. When you fill it with money, once you put money in that limit is gone. If you take the money out, you don't get the limit back. You don't get the room back. It doesn't refresh. Okay? So how do we build room? It's 18% of their prior year earned income to a maximum that the government changes every year. So for 2022, it was 29,210. So you can, depending on what your income is, you earn deduction room up to that limit. And then you have to subtract your pension adjustment. So remember, we've been reporting the pension adjustment. If your employer is putting money into your retirement for you, it reduces what your RSP room is. But then if your pension adjustment goes in the opposite direction, then it gives you more room back. So if they reverse a pension adjustment, you have less money that your employer put in. And then if they put more money in for a past year, it'll reduce it again. We don't do the calculation for that. We just need to let the client know that that happens. Okay, and I have a couple of questions here that I want to get to. So do you earn deduction room when you retire before 71 and take a pension? You have to have earned income. Earned income is working income, so it's income from employment, other employment, or self-employment. If you stop earning income, you stop earning room. Okay. And then the next question that we had, what if you want to save more than the limit for retirement? Is there a way to keep putting it aside without getting deducted from tax? So you can invest in other things for your retirement that don't have to be an RRSP, but that would not be something you would get a deduction for. So yes, you could put money into a tax-free savings account. You could put money into an unsecured or a non-registered investment. You'd have to pay tax on the growth and you wouldn't get a deduction for it, but you can still put the money aside if you want to. Okay, Leon, can you transfer them? I'm not sure what you mean by transfer them, so can you give me some more detail and I'll see if I can answer that question as well. Okay. And it might be that I'll tell you about it next time we talk about RSPs, but I want to make sure I'm understanding your question. Okay, so generally speaking, the government will decide how much room everybody gets, and they will tell you on your notice of assessment how much room you have for next year. And you should not put more than that in, because if you put more than that in, there is a penalty. Because they don't want you saving and not paying tax on more money than they've determined you're allowed to make tax-free. Can you transfer to a spouse or another tax shelter? So you can put money into a spousal RSP if you have contribution room, because if you have contribution room, you can get the deduction for it. If you don't have contribution room, there's no point in putting it in a spousal RSP because you're not going to get a deduction for it. So it's still going to be taxable. Can you transfer things from an RSP to a different tax shelter? There are a few situations where you can transfer money from an RSP to a different tax shelter. We'll talk about that when we do transfers because it's complicated. Okay, and sometimes you can transfer money into an RSP without having room, and we'll talk about that. So like I said, we're going to start with the basics today, get this down really, really solid so that I can make it more complicated when we come back to it. So I want you to understand how RSP deduction limits are calculated generally and what happens. Now, I will say the whole pension adjustment can be a bit of a pain because sometimes the pension adjustment happens in the middle of the year. So I had a client who was very good at investing and putting money aside for herself. She maxed out her RSP contributions every year. When you go to the bank and you buy an RSP, the bank is supposed to ask you what your RSP room is, because they should not sell you an RSP that you cannot benefit from. Do they do that in real life? Well, probably not. They have targets they want to hit. They have a lot of pressure at banks to sell investments. They are supposed to do it, but they don't. So I will say, if you're going to buy an RSP, make sure you know what your room is before you put it in. But sometimes, even doing it the right way, you've checked your room, you've made sure you're only contributing what you're supposed to be contributing based on your notice of assessment. In that case, you can still run into a problem if at the end of the year, your employer does a pension adjustment. Because if they do a pension adjustment, it's going to reduce your RSP room, but you've already put the money in. And that happened to a client of mine. She maxed out her RSP every year, which she was allowed to do. but she was a nurse, and depending on how things worked with nursing pensions, they'd had a whole bunch of adjustments. She got a letter from her employer saying, we've done a pension adjustment. Don't worry, you don't have to take money out of your RSPs. That was bad advice because the pension adjustment reduced her RSP room for the year, and she had overcontributed because she was maxing it out. Now, in her case, there were two things we could have done, and we'll talk about what happens when you overcontribute. You can take money out. And there's a special way to do that without being dinged with a tax penalty if you catch it in time. In her case, we were lucky because she also had a home buyer plan, so we were able to apply the excess against her home buyer plan and not have to do anything for that year. But a pension adjustment can happen after the fact and can really mess with your RSPs if you're contributing at the maximum. I will say a lot of the clients that I get do not contribute up to the max. So it's very rare, unless you have clients with a lot of money or clients who are very good at living on a budget, that they're going to max out their RSPs every year. You should, every time you do RSPs and you put them on the return, before you do anything else, make sure you know what their limit is, because if you go over your limit, there are penalties, which we'll talk about. Okay, why are all of these rules in place? So you're getting a deduction, you're not paying tax now, you're not paying tax on the growth. Why is the government saying you can't put more into an RSP than this amount, and also you have to stop contributing when you're 71? Why would the government do that? What's the incentive for the government to put a limit on it and then to say when you're 71 you can't put any more in? And in fact, what they say is when you're 71 you have to start taking it out. When you're 71 you have to start drawing your RSPs out in one form or another. Why do they do that? Because they want to get paid eventually. Again, most people will need to draw on their pension income at some point in their life. But very, very wealthy people would be very happy if they could just put money in, make it not taxable, have it grow tax-free, and then transfer it to someone else someday and never, ever pay tax on it. So they are giving you a really nice deduction, and they're sheltering a large amount of tax for most of your life if you leave it in that RSP for most of your life. But at some point, you have to pay your taxes. So they are going to require you, this is to save for your retirement. When you retire, you have to use it. That's really what it's about. Okay? So make sure you're checking RSP limits. Know what the limit is. Don't go over the limit. Okay, I want to see what's on my next slide before I go over to make sure I didn't miss anything. Okay, what is earned income? It is income from business, so employment and other employment. It is net income from self-employment. CPP disability payments counts as earned income. Rental income counts as earned income. Taxable support payments, we'll talk about that when we get to families. If you are receiving spousal support, that counts as earned income and is going to increase your RSP room for next year up to the max. And then contributions to an amateur athlete trust, which you'll never see, but there it is. There's a note about that. That's going to increase your RSP room for next year. There are also things that can reduce your RSP room. So union dues will reduce your RSP room because you're getting a deduction. It's not earned income because you're not actually going to be paying tax on it. Employment expenses deduction, which will include all of the COVID working from home ones that you've learned. The flat rate is going to reduce your RSP room for next year. Net losses from a business, rental losses, and if you're paying taxable support and you claim a deduction, that's going to reduce it. And then we've talked about pension adjustments as well. So all of this information goes into the government calculator, and the government will then at the end of the year when you file your tax return tell you what your RSP room is for next year. That will be on your notice of assessment. Keep an eye on it, because if you go over, there are some consequences. Okay, now that you know how this works, I'm going to tell you about someone who did a very crazy thing with their money. just because it's my favorite. It's a real world example. I will not name the person, but I knew someone who went to business school and decided that they were going to learn a lot about investing. This is a very rich kid whose parents were paying for everything. So what happened with this person, who's in his second year of his business program, and he decided he knew about money now. So he went ahead and he took all the money his parents had given him for his tuition for that year, gift from his parents, and he's an adult, no attribution rules apply, and it's a gift so it doesn't go on the tax return, right? Took all that money and put it into an RSP. Why was that a bad idea? Let's start there. Put a whole bunch of free money. It wasn't taxable before, now it's taxable. Great. Also, he used up his deduction room. So he went ahead after putting it all in for about a couple of months, and he heard about a really great stock tip that you can't get inside an RSP. So he took it all out. Took it all out. What happens? When you take money of an RSP, what happens? You pay tax that year. Put it all in this stock tip. Turned out not a good stock tip, lost it all. Couldn't tell his parents that he'd spent all the money they'd given him for his tuition for that year. So he took out a loan. So that was a very expensive way to learn about how income works and investments. So don't do that. The thing to remember for your clients, when they get a windfall, when they get a gift, when they get an inheritance, when they win the lottery, it might be a good idea to put money into an RSP if you have a lot of employment income as well and all your income is mixed together. But it might be better not to do that. And did the loan cover the tax bill and tuition? Yeah, basically he had to take out quite a bit, and then he paid interest on the loan for a number of years. Yeah, it was a very, very, very expensive lesson in what not to do with investing, what not to do with tax, and what not to do with investing. So sometimes your clients are going to have a windfall and they're going to put it in RSPs, and that's not necessarily a bad way to deal with it if that's the free money that they have. But it is important to let them know what the consequences of that are. If they have another option, have them use the other option. And think about money. Not all money should go into an RSP. Only money that's already taxable, where possible, should go into an RSP. And you're only delaying tax if you're in the lowest tax bracket. The best case scenario, you're delaying tax. The worst case scenario, you're increasing tax. So generally, RSPs are not the first thing you're going to do if you're in the lowest tax bracket. You're going to look for other ways of sheltering tax, paying less tax, rather than an RSP. As you move up higher tax brackets, RSPs become valuable to you because then you're not just delaying the tax you're paying, you might actually be reducing the tax you're paying. So these are things I want you to think about. Yeah, free money, pay off your mortgage, pay down your debts, invest, put it in a tax-free savings account, put it somewhere else that's not taxable if you can. Okay, so what happens if you can't put money into an RSP because your room is too low? You can carry it forward as undeducted contributions. You don't have to. Or if you have a client who put money into an RSP and they don't need the deduction this year, think about someone where they've only just gotten their big job, right? It's the first time in your life you're making money. You've worked at this new job for like 2 or 3 months, so you have a little bit of income this year. You're in a low tax bracket. But next year, you're going to be in a higher tax bracket. Save that deduction and use it next year when you're in the higher tax bracket. So you'll see a lot of young people will come out of school and they put money into RSPs because someone told them they should, but they really don't need the deduction this year. Save that deduction because when they graduate from school and they become, I don't know, a doctor, a lawyer, and now they're making 6 figures, now that deduction can be applied in the future because it's been carried forward and it will be worth more to them then. Helene, what about young people with a job that has no pension? There are other ways of saving. It doesn't have to be an RSP. So you can pay into your own pension plan essentially for yourself by just saving in a savings account and an investment account. A tax-free savings account is my best advice for young people. Young people should be maxing out their tax-free savings accounts before they start worrying about RSPs. And then think about it this way. If you put money in a tax-free savings account, build it up, then you get that big job and now you want to buy RRSPs, but you don't have a whole lot of disposable income because you also have a mortgage and kids, you can take that tax-free savings account and use that to buy an RSP. Then you still get the deduction and all the growth in tax-free savings account has been free. That's an option too. All of this we're getting into financial planning advice, but it is tax advice as well. So from the tax side of things, I really want you to be thinking about when do we want to give people advice from a tax perspective of an RSP as compared to something else. All right, so if you have undeducted contributions, you can choose not to deduct them and carry them forward. Sometimes you can't deduct them because your room was too small, and in that case, they will carry forward to a future year because you do not have a choice. You put the money in and you can't deduct it. We run into a problem if you do that too much. So I want to talk about excess contributions. Okay, if you put more in than your limit and you're 19 or older, you have a $2,000 buffer. So you're allowed to make the mistake by about $2,000 of overcontributions before you're going to be penalized. But after that, you get a penalty of 1% per month on all the contributions that are over that limit. And that penalty continues ongoing until you take the money out or until your RSP room goes up and you can use it. Okay, so that's really important to know, because if you overcontribute, that penalty is going to kick in and it's going to stay there until you build enough room to cover it or until you take the money out. Here's a problem. If you put the money in and you can't deduct it because you have no room, then you don't get a tax deduction. You have to pay tax on that money. What happens when you take money out of an RSP? You get taxed on it again. So there are two penalties for overcontributing. The first penalty is the 1% per month. But then when you take it out, because you couldn't deduct it, you get penalized again because you pay tax twice. It's very rare that you pay tax twice on anything in Canada. This is one of the times you do. The consequence for overcontributing is you don't get the deduction, so you pay tax on the income up front. And when you take it out, you pay tax again. There is a special rule that says that when you take it out, if you take it out in the same year that you overcontributed, if you have a window of time, there are two different forms you can use. I'll talk more about this later if we have time, and there's information in the book. One of the forms you do ahead of time, you take that form to the bank and the bank withdraws it using that form. It will not charge the penalty when the money comes out of the RSP. If you do it in time and you use the right form. There's a second form where if you really don't have time, so your client has already overcontributed, you've told them you're about to hit the deadline, you've got to take the money out so you're not paying lots and lots of penalties. There's a second form you can do after the fact and ask the CRA to adjust for you that will not double tax you. Once you pass the deadline, though, the penalty is the penalty. You're still going to have to do the penalty per month, and if you leave it in long enough, by the time you catch it, you're also going to have to take it out then to stop paying the monthly penalty. And on top of that, you're going to be double taxed on it. So this is an expensive mistake for your clients. We had a scenario where we had a client who someone else had done their taxes, and they had overcontributed by a lot. Like we're talking 5 digits, lots and lots of overcontributions in a year. Their bank didn't catch it, partly because they had two banks. So they were contributing automatic payments in one bank and automatic payments in a second bank. Okay, the banks should still be checking, but they didn't. And partly because the person who did their taxes didn't know about RSPs and didn't catch it. And then that person continued to do their taxes for another 6 years. And then they came to us. And we went into their file and they had undeducted contributions of like, oh, I don't know, $60,000, $70,000. and an RSP room of 0. And unfortunately for them, we could not get them to take the money out in a way that would not be taxed, double taxed. And we also had the problem of 6 years of monthly penalties of overcontributing. So what you need to know more than anything else is if you have a client who's put a bunch of money into an RSP, take a look at their room and limit, make sure they have room. If they don't have room, have a chat right away. Go find a senior associate who can maybe help you see if there's a way of getting out. Have a senior associate who can help you file the penalty. The penalty for excess contributions, there's a form called a T1 OVP. There's a little bit of information about it in the course as well. That is a form you have to learn how to fill out. We're not going to teach you that form in this class. That's going to be an upper level thing. But you do need to know that there's a problem, and you need to know that there's a solution if they go find a senior associate for help. Okay, all of this, everything over the $2,000 buffer. You have $2,000 to go over. So if your RSP limit is 0 and you put $2,000 in, you're fine. Don't worry about it. Don't put any more in until you get a new set of information about the room. But you're okay. If you put $2,000 in one, you're paying penalties on that $1. And then if you put $4,000 in, you're paying penalties on $2,000. Everything over the buffer, you're paying penalty on. If you're under 19 and you overcontribute, pay penalties on all of it. Okay. So again, I'm going to go back to the issue of how you build RSP room, and I'm going to tell you about another client that I had. This is a client who worked in the construction industry. He was relatively new to Canada. He was filing his very first tax return, and all of his friends and coworkers and colleagues were like, oh, Guy, you know, you're going to make a lot of money. You definitely need to buy RSPs. So he went to the bank, and he bought a $10,000 RSP. What's the problem? How do you get RSP room? He had no earned income. He had no RSP room. He had never reported earned income because he'd never filed a tax return before. So what did he have to do? Fortunately, he put the money in September, and he came to us in February. He had to take it out. How much did he have to take out? He put $10,000 in. How much did he have to take out? $8,000 because there's a $2,000 buffer. Now, if he earned enough so that his RSP room next year would cover it, in that case, we don't have to take it out. He is going to have to pay the penalty, but if his RSP room will cover it for next year, we can leave it there and he'll be able to deduct it next year. So that's the best option for him. See how much room he built. Did he build enough room to use it? If he did, then we can leave that much in plus $2,000. And then anything over that new room amount, we did have to take out. Okay. How that's going to work, you're going to go get a senior associate to help you. Recognizing the problem, that I do expect you to know. All right, let's do a little activity here. So what I'm going to ask you to do, I'm going to let you annotate if you want to, or you can just type in the chat window. Before you put RSP contributions on a return, you need 3 things. I want you to tell me what 3 things you need, and then if you know what you need, how do you get it? So the client says, I want to claim an RSP deduction on my return. I'm going to say, that's great. What do I need? Okay, I need a notice of assessment. Why? RSP slip. So that's good. I'm going to put this in for you. Let's see, I think I'll do it in blue so you can read it. I need an RSP receipt. Where do I get an RSP receipt from? The bank. Good. What else do I need? I need the room. And I think most of you have agreed that comes from notice of assessment. Good. What's the other thing I need? What's the thing that has to go on top of my Schedule 7? What is the first line on the Schedule 7? not income. Undeducted contributions. All right, I need to know what other contributions I have as an option to deduct for this year. Maybe there were things they couldn't use in the previous year, maybe things they saved. Where do I get undeducted contributions from? Not necessarily notice of assessment. Where else can I look for it? My account. Represent a client. Autofill my return. All of those places will have it. Your client will have that information. Or if you have represent a client, you can get it. So this is important. Everything you want to do for RSPs, you should be checking 3 things. I want to see the receipt. Check the tax year on the receipt. Your clients get very mixed up. I want to see the RSP room from the notice of assessment. Also, notice of assessment, RSP room will also be on Rep a Client. And it will be on the AFR. And it will be in my account. And it will be in my CRA if they have the app on their phone. There are lots of places to get that. The banks should be asking for it. They don't, but they should be. Your financial planners should be asking for it if you're going and buying an RSP. Lots of places you could find that. And then undeducted contributions. Don't forget the undeducted contributions. We had another one where we had a client where they had undeducted contributions. They weren't over-contributed. They had just never deducted it in previous years. Of like $12,000. And whoever had done their return before didn't check for it. And they had a very high income. What would happen on their tax return if we gave them a $12,000 deduction and they're in a high income tax bracket? Nice refund. They were very happy with us. That we noticed that they had undeducted contributions they hadn't used, and it was a good time to use them. So we did. Go looking for them. Find money for your clients. This is one way to do it. All right, I'm going to test 2 more things, and then we're going to take a break. So remember, for spouse or common law partner RSPs, they own the asset after you put it in. Contributions are claimed by the contributor, and they're limited by the contributor's deduction limit. Remember that rule? We talked about that already. Let's do a little activity here. So we have James and Marta. James and Marta are married. James is 34, Marta's 31. James has an RSP limit of $5,000. Marta has an RSP limit of $3,000. Marta has purchased an RSP for James. It's a spousal RSP in the amount of $4,000. And I'm going to do a quick poll here. And let's see if you know which of these statements is true. Okay, so statement A, James will report a deduction of $4,000 on his return because the RSP was for him and he has room. Statement B, Marta will report a deduction of $4,000 on her return because she was the contributor and James has an RSP limit of $5,000. Statement C, James will report a deduction of $3,000 on his return because the RSP was for him, but Marta only had a $3,000 limit. Or statement D, Marta will report a deduction of $3,000 on her return because she was the contributor and she only had a limit of $3,000. So one of those is correct. Which one is correct? Think about who's the contributor. Think about who's the annuitant. Who reports the deduction? Whose contribution room is important? Okay, I'm still waiting for a few people. I find the visuals of the contributor and the annuitant hats very helpful because I attach the rule to the hat. and then I think about who's wearing the hat and what rule applies. That's how it works in my head. You'll find something that works for you. Okay, a few more people, 15 seconds left. Hit the submit button if you can. I like to see how everyone's doing. Okay, let's see what we've got. So let's talk about who is the contributor. Marta is the contributor. Who claims the deduction? The contributor claims the deduction. So Marta is the contributor. Marta claims the deduction. Whose RSP room matters? The contributor or the annuitant? The contributor, right. So most of you got that Marta has to claim it, which is excellent. If you got that far, you're already doing really well. The thing to remember is when we look at the deduction, we are filling out a Schedule 7 for Marta. We need Marta's room. Marta's room is $3,000. So how much can she deduct? Only $3,000. What happens to the remaining $1,000 that she cannot deduct this year? So I've given you the answers in the poll. The correct answer is Marta will report $3,000 because she's the contributor and her limit is $3,000. She carried the $1,000 forward. Good. Does she have to worry about the overcontribution? She's 31. No, she gets a buffer of $2,000. She's okay. She can leave it there. She doesn't have to do anything. And hopefully next year she'll have enough room and she can claim it next year. These are all things we should think about. And I would say overall you guys did really well on that one. So I'm going to try one more. I'm going to test the boundaries just a little bit. And gotta go back. Let's see if we can try this again. Luke and Sam. Luke is 73. Age is important. Oh, Marisa, very good question. I'm going to go back one because that's an important question. She would have to report the $4,000 if she wants to carry it forward. So if she wants to carry it forward, she's going to report all the receipts, and then she's going to deduct $3,000 this year and carry $1,000 forward. If she doesn't report all of it, she won't get the deduction next year without doing an adjustment. So put it all on the return, put it on the Schedule 7, but remember she's limited to what she can claim. Very good point. Okay, so let's try the next one. Luke and Sam. Luke and Sam are married. Luke is 73. Sam is 68. Luke has an RSP limit of $20,000. Sam has an RSP limit of 0. Luke wants to purchase a spousal RSP for Sam in the amount of $6,000. So I want you to think about the rules for contributors and the rules for annuitants. And we're going to do another test. Age matters in this one. Notice their ages. And let's see what we get. Okay, same thing. Which statement is true? Statement A, Luke cannot purchase an RSP because he's over 72. So remember, you turn 71 in the year. Statement B, Luke can purchase the RSP because he has a high enough limit and Sam is under 72 years old. Statement C, Luke cannot purchase the RSP because even though Sam is under 72, Sam's limit is 0. Or statement D, Luke cannot purchase an RSP for Sam, but Sam can purchase one for himself. Okay, one of those is correct. Let's see if you can find it. Who's the contributor? Who's the annuitant? Whose contribution room matters? Whose age matters? Think about all of those rules, and you'll probably get the right answer. Okay, got a a couple more people I'd like to give this one a try. Hit the submit button if you can. $20 seconds left. Okay, let's see how we did. And I would say I'm impressed. You guys did really well. Who's the contributor? Luke, the annuitant of Sam. The annuitant's age matters. Sam is under 71. The contributor has to have room. Luke is the contributor. Luke has room. So Luke can absolutely purchase a spousal RSP for Sam. We don't care what Sam's limit was. We just care what his age was. Everyone see how that works? Can Luke buy one for himself? He's got room. Can he buy it for himself? No. His only option, if he wants to get a deduction on his tax return this year, is to give the money to Sam through the vehicle of purchasing a spousal RSP. But he can if he wants to. So he can get a little bit more deduction in there as long as Sam continues to be young. Okay, good. Let's take a break. This is a good place for a break. I'm going to give you a longer break. We're going to take a break right until 11 o'clock. And then we're going to come back and talk about some more things. All right, nice long break. I don't get to give you long breaks all the time, so let's see if you feel refreshed. Give me a green check mark if you're back. Let me know how you're feeling with your emoticons. Let's see how we're doing. We're going to jump into how to get money out of an RSP without paying tax on it, which is one of the things everyone likes to do. And we're going to talk about a few other RSP adjacent things. We're going to talk about RDSPs, and we're going to talk about TFSAs a little bit. So first thing, home buyer's plan. Please, please, please do not get this mixed up with the home buyer's amount. The home buyer's amount is a credit. It is a non-refundable credit that you get if you are a first-time home buyer. Some of the rules for whether you can take money out of a home buyer's plan are the same, and it has the same name. But a home buyer plan is income. It is not money you're putting in. It's not a credit, it's income, so don't mix them up. You're going to get very confused if you do. And although some of the rules are the same, they're not 100% the same. So put home buyer amount and everything you know about it in a box, put it to one side, and let's talk about the home buyer's plan. If you want to take money out of your RSP in order to help you buy a house, and it's the first home you're buying, broadly speaking, you can take currently up to $35,000 out of your RSP without paying tax on it. You have to be a first-time home buyer. That is the same test that it was before. You can't have lived in a home that you or your spouse owned in the last 5 years unless the reason you're doing it is to purchase a home because of a disability that needs to be accessible. There's one more special rule about spouses and the breakdown of a relationship. Can anyone in the chat window tell me what that is? What is the extra thing for home buyer's plan? This is relatively new, but it is in the textbook. Did anyone find it? If you are buying a home because of a separation or divorce, then even though you were not a first-time home buyer, you may be able to access your home buyer plan as well. There are special rules for that. If you think that applies to your client and you're giving them advice because they're in the middle of a messy breakup and they don't know how they're going to buy a house because they can't afford it, you can refer them to some of that information and have them talk to their financial advisor for more details. Okay. But generally speaking, you have to be a first-time home buyer. So Helene, what if one spouse owned before but you didn't? The problem we run into with the first-time home buyers is if you lived in a house that you or your spouse owned, so if your spouse owned a home and you lived in it, then normally you're not a first-time homebuyer. You don't get the homebuyer amount for that. So similarly, the rule was in that circumstance, you would also not be able to withdraw under a homebuyer's plan. They've made an exception to that rule. So there's a special rule now if it's because of divorce. Okay. On the other hand, if you're not divorced, if you're both together and your spouse is selling the house that they lived in and you want to access your homebuyer plan because you're buying a house together now, too bad for you. If you lived in that house, you're not a first-time homebuyer. Okay. So that causes a problem. And so be careful with that. If it's not on paper separation and it doesn't last, it's not going to work. They have thought about that. Believe me, any loophole you think of, the CRA has already thought of. If you're curious about this, you can look in the textbook for the form that is used, or on the CRA for the form that is used to withdraw a homebuyer's plan, and you can see the questions you have to answer in order to qualify under the new special rules for people who are buying a new home because of a separation or divorce. Okay? So generally speaking, and what I do need you to remember, if they're a first-time homebuyer, they can access their homebuyer's plan. They have to have a written agreement to buy or build a qualifying home before they can take the money out of the RSP. So you have to have the agreement first before the bank will give you the money. And then you have to complete the purchase before October 1 of the year following the year of withdrawal. You actually have to close on the deal. What happens if you don't close on the deal? What do you have to do? You have a year and a bit, depending when you buy it, and it doesn't close. It falls through. You have to put the money back in to your RRSP. If you took it out of an RSP that was in your name, you have to put it back in an RSP in your name. If you don't do that, you'll be penalized as if you had taken the money out normally. So, Brittany, couldn't you just pay the tax on withdrawal? Yes, but think about it. Do you want to pay tax on $35,000? If you took the max out on the homebuyer plan and then your house deal fell through? Because it's going to change your tax bracket. So if you don't want to pay tax on it, you have to put it back in. So yes, you could keep it, but if you keep it, it will be treated as a regular withdrawal. That's the penalty. Okay. The other rule, which is important, and Leon, if it's delayed but it's still going through, are there exceptions? Not really, because it's a very long period they've given you. So then no. They're strict because it's a very nice thing they're letting you do. You have to close. You have to get in the house. They're doing this so that you can get into your house. So if you don't get into the house, then you shouldn't have done it. Okay. So you have until October 1st of the year following the year of withdrawal. So if let's say you're buying the home in February of 2021, you have until October 1st of 2022 to close on the home. Okay. You do have to leave the money in the RSP for at least 89 days, so 90 or more if you want to get the deduction. Okay, because, like I said, everyone who sees this, they're like, aha, I have a great plan. I would like to buy a house with a down payment, but I also want to have RSP deductions. So I will put $35,000 into an RSP today, and I will take it out tomorrow, and I will use it to buy a home. And then I will have 15 years plus 2 to repay it. Isn't that great? And the CRA said, nope, you can't do that. The goal of an RSP is not to buy a house. The goal of an RSP is to put money for your retirement. So it has to be in there for at least 89 days. Now, what if you didn't? What if you had, because remember, most of the time we do this after the fact. Our clients have already done a thing, and then we get receipts. If you have a client who put, let's say, $10,000 into an RSP and then immediately, within the 3 months, took it out under the home buyer plan, will they get the deduction? No. So they will have to pay tax on that income because they're not going to get the deduction. They have, however, taken out a home buyer plan, which they will have to repay. If they don't repay the home buyer plan, or if they do repay the home buyer plan and then later they take the money out of the RSP, what happens? Because they're going to take that money out officially at some point. What happens? They pay tax again. The penalty for doing this is you get double taxed. You don't get the deduction. You're not allowed to put it on a Schedule 7. And you are going to have to pay it back to your home buyer plan because you took a home buyer plan out. And when you pay your home buyer plan back, once you take the money out, you're going to pay tax on the money a second time. That's the penalty. So it's very important that you do not withdraw it. There are calculations in the textbook to help you figure out how much you can take out, because you can take out the growth. You just can't take out what was already in there. General rule of thumb, take a look at how much money they have in the RSP, subtract any contributions they made in the last 90 days, and the difference is what they're allowed to take out under a home buyer plan, okay? And still get the deduction. Okay. This is generally something that the bank is supposed to be careful about, your banker, your financial advisor who's selling you your RSPs. They should be keeping track of how much you're taking out, and you should be keeping track of how much you're taking out. It does get complicated if you take out too much, or if you take it out early and you're getting bad advice. So if you take out too much, what happens? I'll give you an example. If you have a client who has, let's say, $20,000 with one bank and $20,000 with a different bank, they go to the first bank and they say, I want to take my money out under home buyer plan. The first bank says $20,000 is under the maximum, sure, and they give them $20,000 under home buyer plan. They go to the second bank and they do the same thing. Now they've taken $40,000 out. What will happen to that client? $5,000 will become taxable income. It will be a regular one. Okay. The banks should be checking. Every bank should be asking you, are you taking money out from somewhere else? Make sure you don't take more than the max. I had a scenario, which was when this was still pretty new, with a client who had 2 RSPs with the same bank, and they took out $38,000, and they should only have taken out $35,000. The bank should not have done that. They knew about the other RSP. It was with them. And we had to explain to the client, we have to report the home buyer plan, but we're going to have an adjustment, and some of that's going to be taxable. Okay. So this is a messy situation. If it happens in real life, go find a senior associate to help you with the overpayment or over withdrawal, because it's complicated. It doesn't happen in an easy way. But it is important to know what you're taking out. And for you, it's important to know if they took it out early. So next question. If your client bought an RSP in, let's say August, and they took out a home buyer plan in September, how will you know that they took it out too soon? Think about the receipts. Your RSP receipt will say March to December. You know it happened sometime between March and December. And the RSP withdrawal receipt will not have a date on it, except they will tell you that you took the money out in 2021. How will you know that you have to worry about this? Because sometimes it's not about knowing the tax theory, it's about catching the problems when they happen. How will you find out about it? You know it needs to be in for 90 days. You have no idea when it went in or when it came out. You know that money went in and you know that money came out, but you don't know the dates. How do you find out? You have to ask. You have to be talking to your client. If you see a contribution and an RSP withdrawal under a home buyer plan, sit down with the client and go, I need to know the timing of all of this. When did you make your contributions? Was it before or after you took the money out of the home buyer plan? If it was before, which it probably was, you're going to need dates. And you're going to need the totals of what was already in, because if they had lots of RSPs and they only took some out, you're okay. But if they, you have to sit down and figure it out with them. If you miss it, you will allow a deduction that the CRA knows is not valid because they have the dates. They may not catch it up front. You'll file a return. The client will get a refund. The client is happy. But a couple years from now, the client's going to get a letter, and then the client is not happy. So you have to have a conversation. If you see money going in and money coming out, remember there's a 90-day rule and do a little bit of digging. Okay. And again, same thing, make sure if you think they've withdrawn too much, you're going to see they've withdrawn too much. Do a little digging and warn the client of the consequences of taking too much out. Okay. So, first-time home buyer, you must not have lived in another home owned by yourself or your spouse in the year of purchase or 4 preceding years. This is waived with a disability. Yeah, Brittany, the self-reporting thing is so that they have to do less work, so we have to do more. And that's why we have jobs in tax. All right, and then the other thing on here that I want you to remember, it's not on the slide, so you're going to have to make a note for yourselves. There is a special rule for people who are separated and divorced. Go look at the book for the special rule. I'm not going to do it in detail because, again, we have not done this. It happened already. So I want you to remember, home buyer plans, your client has come to you with a thing they have already done. If they put money into an RSP and they've overcontributed, it is a thing they have already done, and you just have to help them deal with it. Okay? Once you buy a home buyer plan, there's a couple things you have to do. You have 2 years to repay. So repayments start in the second year after the withdrawal, and dates are provided in the book to help you if you're a visual learner who wants to see if I took it out in this year, it comes out and repay it in this year, all that stuff. You have 15 years to repay it. You have to repay it to your own plan. So you can borrow it from your own plan. You have to repay it to your own plan. So think about the scenario where I have an RSP for myself and I put, I don't know, $50,000. That'd be nice. And maybe I also put $50,000 into a spousal plan for my spouse. And then we're first-time home buyers, we're buying a home. Each of us can withdraw under a home buyer plan from our own RSPs. But then 2 years later, we're going to have to start repaying into our own RSPs. Okay, so you have to make contributions. How do you make contributions? You go to the bank and say, I want to buy an RSP. Okay. So you're going to go to the bank, you're going to say, I want to buy an RSP. They're going to say, okay, you're going to get a receipt, and then you are going to report the repayment on your Schedule 7. So I want to show you a Schedule 7. I had a Schedule 7. Where did it go? Here it is. So now we need to look at Part B. You're going to start with your contributions. It is important to know you can only contribute repayments that are made from this year. So undeducted contributions from a previous year cannot be a repayment of your home buyer plan. It has to be current. Okay. So that's going to go here. You have to actually go and buy an RSP in the year. Okay, and it's from January 1st, 2021 to March 1st, 2022. Anything bought in that period of time can be a repayment under your home buyer plan. You're going to take your total contributions from here. You're going to decide out of those total contributions what is available. So what was contributed this year or January, February of last year. Decide how much you're going to repay. And that goes over into this side, and that becomes your contributions available to deduct. It will not reduce your limit because you're repaying it, you're putting it back. So you don't need to have any room to do this because you're repaying something that already had room. And anything you don't repay has to go on your return as income. Okay. I haven't really shown you where RSP income goes, so I'm going to do that really quickly. So you're going to put the repayment as much as you choose to repay up to the maximum that you have to repay. And then anything that you don't repay that you are required to repay is going to be RSP income, and that is going to go here on line 12900. Okay. The government calculates your repayment by looking at how many years you have left to repay and how much you have left to repay, and they just divide it. So if you haven't repaid any and it's 15 years, they're going to take the total, divide it by 15, and that's going to be your required repayment for future years. Okay. So let's say I have to repay $2,000. If I buy an RSP receipt for $1,000, I'm going to put $1,000 as a repayment on my Schedule 7 and $1,000 as income. Or I could repay nothing and make all of it income, but that's generally a bad idea. I'd get a deduction, but the income is worse. Okay, and I'd lose the RSP room, so you don't want to do that. Can I repay early? Can I repay more than the required amount? So let's say I took $20,000 out. Yes, I can repay up to $20,000. If I do that, it will reduce what I have to do for next year. So every time I do, it will reduce what my limit will be for next year. So if you remember, I was telling you about the client where she had unintentionally over-contributed to her RSP because the pension adjustment happened after the fact and changed her RSP room. She had a chunk of money that would have been an overpayment to her RSP, but she had an outstanding homebuyer plan, so we allocated more of her receipts against the homebuyer plan than the government required her to repay. It meant her next year's repayment requirement was lower, which was good, and it meant she didn't have an overpayment to deal with for the T1 as well. So it solved her problem in two different ways. Okay, this is where you get to be creative on a tax return. If she hadn't have had the homebuyer plan, we would have had a different problem. Okay. So you can repay early if you want to, and you can choose to repay less by either not buying an RSP or by not allocating the RSP on your Schedule 7. So you have to choose how much you're going to put, and you're going to put the contribution up to the max here. Okay. Once you have a homebuyer plan, you must file a tax return every single year until your homebuyer plan is fully repaid. So you must. It doesn't matter if you're getting a refund. It doesn't matter if you owe. It doesn't matter about anything. You must file every year until you have fully repaid the homebuyer plan. Okay. And one other rule, a lot of people ask, can you get more than one homebuyer plan in a row? Yes, but only if you still qualify as a first-time homebuyer for some reason. So you might qualify as a first-time homebuyer because of a disability, but also you can't do it if you're still repaying an old homebuyer plan. So you might find a client who took out a homebuyer plan to buy a house, bought a house, moved into it, life happened, sold their house, became a renter for 5 years. Now they're a first-time homebuyer, but they can't get a homebuyer plan again until the first one is paid off. Okay? They get the homebuyer amount. Don't confuse that one. Homebuyer amount is different. But they can't take money out of the homebuyer plan until you pay it back. Think of it as borrowing against your RSP. If you treat it as a loan against your RSP that you have to pay back, it starts to make more sense. Okay? Any questions about homebuyer plans? They're really nice if you have lots of RSPs. Okay, similar to homebuyer plan, there's another thing you can borrow against your RSP for, and that is education. The rules are basically the same as they are for the homebuyer plan. So generally speaking, there's a certain amount you can take out. You have a certain number of years to repay it. You repay it by buying an RSP. If you are required to repay it and you don't repay it, it goes into your income. And you have to fill in a return. You have to file a return every single year until it's repaid. All of those rules are the same. The details are different. So for a lifelong learning plan, and I'm going to apologize in advance, I always call this a lifetime learning plan. It's just a thing that got stuck in my head. So if I get it wrong, I mean a lifelong learning plan. I'll try to call it an LLP. You can take $10,000 a year for a maximum of $20,000 over 4 years. So you have $20,000 total and 4 years in a row to decide how you're going to split it up. And the most in a year you can do is 10. So I could do 5 and 5 and 5 and 5. I could do 10 in 1 year and then nothing and then nothing and then 10 more. I could do 10 and then nothing and then 5 and then 5. I can split it up any way I want to within 4 consecutive years. You have to be full-time enrollment in a qualifying education program of at least 3 months. We'll talk about that when we get to students. You actually have to be enrolled in it, so you have to go to the courses. So you can get an acceptance letter, take the money out, but if you end up not going to school for any reason, you have to pay the money back. Just like if you buy a house with a home buyer plan and you don't close on the house, you have to pay the money back. Same rule, funds have to be in it for 90 days, so more than 89 before you take the money out. And it's going to look pretty much the same. The withdrawal will be a box 25 of a T4 RSP slip instead of home buyer plan. It's a lifelong learning plan. Okay. When do you pay it back? You have 5 years after you took it out, or I believe it's the year after you leave the program. So the reason this gets a bit messier is the default position is that you're in a 4-year degree. You're in a 4-year degree, then you have a year to earn some money, then you have to start paying it back. If you're in a shorter degree, you have a year to start making some money and then pay it back. If you're in school forever, like, I don't know, maybe you wanted to become a doctor, so you go to undergrad and then you go to medical school and then you do a couple years of residency and then you do a fellowship and it's like 15 years later, you're going to have to pay it back sooner. So basically, once you start, you have a maximum of 5 years, or once you leave your program, you have to start paying it back. You have 10 years to pay it back. You have to pay it back into your own plan. And if you don't pay it back and you're required to pay it back, it's added to income and you must file. Okay. Any questions? I did this. I went back to do a master's and was working a couple of jobs, needed to fund it a little bit more. So I took some money out under my lifelong learning plan and I am paying it now. And it was worth it and I enjoyed it very much. Okay. Same rule. You can do this multiple times, but you can't have multiple in a year. So you're going to have to finish paying it back before you can access it again. Okay. How do we report it? You're going to get a tax slip. It will be a T4 RSP slip. There are examples in the tax reference book if you want to see what they look like. There should be an example in your textbook as well. And all you're going to do on your Schedule 7 is you're going to go to the bottom of your Schedule 7 and you're going to find this information here. Okay. You're going to fill in the box 27 if you took a home buyer plan out, and then you have to say if the address is the home because they want to know you moved into the home. Okay. If it's not, you may have to explain why you bought a home and didn't move into it, because they might catch you and make you pay it all back. So tick that box. If it's for a lifelong learning plan, be careful about it today. If it's a lifelong learning plan, you're going to put the amount in here to the max, hopefully of 20,000 or 10,000 in a year is the most you can take out. And then you can take out a lifelong learning plan for yourself or for your spouse to go back to school. So you or your spouse has to be going to school, and if that's true, you're going to tick the box. Okay, so if I were to take out a lifelong learning plan for my spouse to go back to school, I would have to report the income here. It's not going to go on the tax return, and I would have to pay it back. And Brittany, what if you purchase a fixer-upper you want to have as your principal residence, but you're still renting at least until a few renovations are done? Probably not the time to get a home buyer plan. A home buyer plan is intended for you to buy a home and move into it. Okay. So in that case, save your money. But the intention of a home buyer plan is to buy a home and move in it. It's to make it possible for people who could not otherwise afford to buy a house to hopefully be able to buy a house now without losing their retirement savings. That's the goal. Okay. That is RSPs. I'm going to say in its entirety, except of course, I'm going to make RSPs more difficult. Spend a little bit of time really digging into this and getting comfortable with this, because when we start talking about other things, early spousal withdrawals, when we start talking about transfers, it gets trickier. So you need to have this really, really solid. Okay, the next couple of things I'm going to talk about, I'm going to do very, very quickly, mostly because we're not talking about the income, we're just talking about putting money into it, which is not a thing we do except to tell our clients that these things exist. Okay, so I'm going to start with an RDSP, Registered Disability Savings Plan. These are relatively new. We'll talk about it again briefly when we get to medical, because I'm going to tell you what qualifies as a disability as far as the CRA is concerned and how you get that. But essentially, if you qualify as a disabled person, you have the opportunity to set up for that person, for yourself if it's you, or for a family member if the family member is a disabled person. You can set up a registered disability savings plan. You do not get deductions for putting money into this. There's no tax deduction. The benefit of it is that it is a way of putting money away for someone who has a disability, and there are some really nice government matching programs. There are some government grants and bonds for low-income people where if you put money into it, the government will also put money into it, and as long as that money stays in the account long enough, it means that the person who is disabled will have more money in the future. Okay? If you want a lot of details about it, there is a lot of detail in the textbook. The CRA website is excellent in terms of providing information for RDSPs as well, so it's something you can look into. Basically, the money you put in will not be taxed again. Because you're not getting a deduction for it, it will not be taxed in your income, and it will not be taxed by the disabled person who takes it out. The growth will be taxed by the person who takes it out, who is the person with disability. So the growth is taxed. The money you put in is taxed up front because you're not getting a deduction for it. But it is a way of putting more money into the hands of someone who needs it. And again, the main reason people do this is to access the matching grants and bonds. You can contribute up to $200,000 in a beneficiary's lifetime, and it's usually set up by a parent, guardian, or other family member. And Marisa, similar to RSP, yeah, we're going to talk about RSP in details. And Brittany, whether it counts against them for EIA, probably, because it would be income. So when they take money out of it, it will be income for them. I don't know for EIA what they do with assets. So for that, you would want to make sure you saw if they have any rules for reporting what your assets are. Okay, so refund of contributions is not taxable. They're only going to pay tax on the growth, not on the total contributions plus the growth. You can transfer RSPs or RIFs from someone who dies into an RDSP for a dependent child. So that is one way to take money that otherwise they would have to pay tax on up front and make it not entirely taxable. If you have an RESP set up for someone, and we'll talk about this in more detail in the student chapter, if you set up an RESP for someone and they don't go to school because they have a disability, so you set it up when they're young, something happens, it turns out that they're never going to be able to go to school because of that disability. Normally, if you don't use your RESP funds to go to school, you have a tax penalty when you take it out. This will allow you to transfer it to an RDSP, so there is no tax penalty, and it allows the income to continue, the contributions to not be taxed again, and the growth to be taxed in the hands of the person with disability. Okay, we'll talk about that a little bit more when we get to students. Government grants and bonds that are paid into the RDSP, if the plan is closed or deregistered, or if the beneficiary dies or ceases to be eligible, a portion of it has to be paid back depending on how long it's been sitting there. So To keep the full amount of the grants, you have to leave the money in at least 10 years. Okay. When they originally set up an RDSP, they just said if you take it out, any money out in the first 10 years, you have to pay all of the grants back. And that was really onerous because it made it so that almost nobody could get the grants. So now they have a special calculation so that you'll have to pay some of the grants back depending how long you left the money in. The goal, again, is to set up a fund for a disabled person so that when they need it, they have the money there. Beyond that, I'm going to suggest that you take a look at the book, take a look at the Sierra website. We don't set up RDSPs, but you might have a client who would know more about it, and maybe this would be something for them to be aware of. And then beyond giving them the information that you have from the Sierra website, they really need to sit down with a financial planner, someone who does RDSPs, someone who sells them, who can give them more advice for how to deal with it. And Brittany asked, are there special courses to take to become proficient in all things having to do with tax disability? This course, you're going to get a lot of that. So you're going to learn a lot when we get to dependents, when we get to medical expenses, and that chapter that we're doing on that, you're going to have quite a bit of information. And then beyond that, you're going to have the tools you need to be able to understand what's in the resources. I don't know that we have a course specifically for this. Because it is so common, I think it's very rare, and Nancy, you can back me up on this one, it's very rare that we have a year where you do taxes where you're not dealing with a disabled dependent. It's just, they're very common, lots of people have them. And so we cover most of what you're going to need in this course for that reason. And Leon, at what point do I draw the distinction between tax advice and completing returns with the client? Well, I do my clients' returns. So mostly what I do, and if you've ever come to H&R Block, you know we don't charge up front for our returns. We do the full return at no fee, and we only charge the fee if they want us to file it. My job is to convince the client that I know what I'm doing so much that they want to pay me to file their return. I usually don't have a problem with that. I do very complicated things. But I have lots of clients that I give advice to, and that's part of the fee they're paying for when they come to H&R Block, because if you work for H&R Block, we have all been trained with all of this specialized knowledge. So when you pay your fee, you actually are paying for year-round advice and guidance for all things tax, as long as you're our client. All right, so RDSPs, that's RDSPs. You know that they exist. We'll talk a bit more about transfers when we make things more complicated. We'll talk more about who qualifies for an RDSP when we get to the chapter on dependents and on disabilities. But I want to have the idea in your head that they exist, and you have a little bit of time to dig into it if you're interested. All right, and then the big one, tax-free savings account, relatively new, started in 2009. And they give you a limit of $5,000 a year. And then for a couple of years, the limit went up to $5,500. Does anyone know what happened in those couple of years where the limit started jumping around? It went up to $5,500, then went up to $10,000. What did we have between 2014 and 2016? Big election. You're going to notice taxes change when there are large federal elections, because people make promises to try to get people to vote for them. So we see changes in the tax return, particularly in those types of years. Okay, and then for 2016 to 18, it was $5,500. 2019, 2020, it's been $6,000. This is cumulative. So if you are eligible, so if you're a resident of Canada, 18 and older, and you file a return, or basically if you're resident in Canada, 18 and older, you have RSP room, or TFSA room, sorry, TFSA room, and it just continues to accumulate until you put money in it, okay? You can't put more than your max. If you do, there is a penalty. We'll talk about that, okay? You can carry the unused contribution room to a following year, and the difference between the contribution room for a TFSA and an RSP is if you use your TFSA and then you take the money out, 1 year later, you get the room back. So remember, with an RSP, once you put the money in, you've used up the room. If you take it out, you don't get the room back. With a TFSA, after a year is over, you get the room back, and you can start contributing to it again. Okay. It is 1% per month penalty for excess contributions. And one thing you should be aware of is if you leave the country, if you stop being resident in Canada, you have to stop putting money into a TFSA. And Brittany, excellent question. If your TFSA grows, does that growth take up your room? It does not. So the room is for your contributions. The growth is just free. TFSAs are wonderful. The idea of a TFSA is it's fair because everybody has one, whether you have a lot of money or a little bit of money. In real life, people with a little bit of money don't put savings in TFSAs because they don't have savings, because they don't have a lot of money. So in real life, TFSAs have benefited wealthy people more than poor people, but theoretically, they are accessible to everyone as long as you have money you don't need to live on. Okay? We should be being careful. If you have a client who is close to their contribution room or likely to max it out, make sure they know there's a penalty. It's 1% per month for excess contributions. How you calculate the contribution room, there is an example in your book. Mark that page because we're going to ask you to do it on the review problems every now and again. Okay, how do you know how much room you have right now? Because the problem is what you have right now might depend on what you put in or took out after you got your notice of assessment. So your notice of assessment will give you your TFSA contribution room for January 1st of the previous year. Then you have to do an adjustment for contributions that you've made since that number happened and a couple of other things. And so all of that adjustment is on this form here. I think they have calculators on the CRA, although the calculators in the CRA can be a little buggy. So I honestly use the textbook example as my base for when I have to do calculating for this. I think it's really nice because you can actually see how it works. They give you the most complicated situation and you just plug the numbers in from there. Okay. So again, make sure people are not putting in more than they are allowed to put in. And if you know your client is about to leave the country and they have automatic payments on their TFSA, maybe let them know that they should stop doing that. Because if they're not resident, they cannot contribute to TFSAs. And they'll have penalties and they'll have to take it out. But this is a really nice way of sheltering investments. You're not going to get a deduction, but the growth will be tax-free, which is something fun. Is the TFSA limit in your CRA account? Yes. But it will only be accurate to the last notice of assessment. So you will know what the TFSA limit was, but you're still going to have to calculate what's happened from that point in time until today. So again, if you have someone who's really close to the limit, you're going to have to find out how many contributions they've made since whatever note was there. Okay, so it's not to the minute up to date in your CRA account. It's to the last recorded date. Right. I thought I had another slide, but I think I didn't include it. So all I want to remind you of, do you remember we did a little activity with tax-free savings account? When do you pay tax on the money that you put into the tax-free savings account? Before you put it in. So it is taxed money. It is already pre-taxed money, unless it was never taxed in the first place. So this is a good place to put your lottery winnings and your inheritance and all of those things, because if it's tax-free money before, it's tax-free money after. When do you pay tax on the growth in a tax-free savings account? Never. That's why we like them. The growth is tax-free. The contributions are not tax-free. The growth is tax-free. So I will have clients every year who will bring me their financial statements with their tax-free savings account income, and they will say, you need this for the tax return. And I will say, congratulations. It's wonderful that you have a tax-free savings account. I don't want to see that piece of paper. Thank you very much. Take it away. Everything that grows in it is tax-free. All right, we have just enough time to do at least one review problem. Let's see how much we get through. I don't think these ones were crazy hard, but let's take a look. All right, we've got Maria. Maria Perez, born September 9th, 1983. She was living in a town kind of far away from here, but in Manitoba. And then she found a new job in Winnipeg, in my case. And then April 1st, she started working in her new job. So, are we going to give her moving expenses? Yes or no? Yes. The clue is that I gave you a lot of details about her moving expenses, so I probably did that because I want you to do it. But yes, it is a new job. She moved for the new job. She moved more than 40 kilometers. We have income from the new job to claim it against, so we're going to do that. All right, we have U-Haul rental. U-Haul rental, yes. She drove her own car. I can do simplified method for her own car. She purchased one meal. I can do simplified method for the one meal that she purchased. She canceled her lease, $650 penalty. Yes, I can claim that. She had legal fees when she bought her new home. Can I claim the legal fees on her moving expenses form? No, because she didn't sell an old home. She was renting. If you didn't sell your old home, you cannot claim the fees on the new home. So if you did put the fees on your moving expenses, go back in and take them out. Okay, so that one I'm going to cross off. All right, she withdrew from her home buyer's plan for the down payment. It's the first home she's owned. I have to deal with the income on the Schedule 7. What else can I give her on her tax return? Because I know she's never owned a home before, and now she has. I can give her the home buyer amount. So I'm going to do that because it's a nice $5,000 credit. So I'm going to write in home buyer amount, $5,000, make a note of it. Okay. She also stayed 7 days at the Shady Rest Motel because she wasn't able to move into the new home right away. What can I claim for moving expenses related to that? I can claim the hotel. I have a receipt. Accommodation, I need to know how many nights. And meals. What's the maximum number of days I can claim this for? In her case, it's 7 because she was there for 7. But what if she had to be there for longer? Up to 15. Good. So this is like a refresher of everything you already know. And she had a reimbursement. So don't forget, she didn't actually pay for all her moving expenses. She paid for all her moving expenses minus the $500 that her employer paid for. So I'm going to circle that, and I'm going to make sure it goes on the T1 as well, T1M. All right. I also know she was unemployed, but she has income from a mortgage. Now, this I know people find confusing. We always think of mortgages as things that we pay. But you could loan money to someone else, and you could give someone else a mortgage. So if she's getting money from a mortgage, it's not going to be a deduction or a credit. It's going to be income. And in this case, I know that she has no tax slip for that, but she has income of $5,106. She doesn't want to tell you about it. She doesn't want to put it on the return. You found out about it. Now what do you do? How are you going to convince her that she needs to report that? You tell her she must because why? Because I'm mean and I want her to pay lots of taxes. I think some of my clients think that about me. I try to tell them the other things. What are the sorts of things you would say? This is good practice. It is a source of income. It is reportable and taxable income. Not reporting all your income is tax fraud, so don't do that. And remember, the government will probably know about it, right? There are lots of reasons people will claim mortgage interest as an expense or deduction on their returns. So it's not something you can really get away with. It's tied to property that they know about. The mortgage is registered on title. Her name is registered as the person they're paying the mortgage to. There's lots of reasons why the CRA might find out about this, and then she could be in trouble for not reporting her income, so she should. And Leon asked, would it be treated as interest? Yes, this is interest. It's not reported on a slip. Mortgage interest. And Helene, it's not rental income because she doesn't own the property. The person who's paying her a mortgage owns the property. So they might have rental income, or they might just be living in it. Yes, but it's a sale of a property, so she sold it. Okay. So the interest is income to her. What she does with that money is an investment. And this is where, if you start to have to think about the direction the money is going. When somebody has a mortgage and they pay interest to her, it's income. If she takes that money, puts it in a tax-free savings account, and the tax-free savings account gives her income from that, that portion is tax sheltered. But the person giving it to her in the first place, that's income for her. Okay? I know it's confusing, so I want you to think about how the money is getting to her. The chunk of money that's getting to her is mortgage interest, it's taxable income. The growth on that, after she invests it, is tax-free income. There's more money coming to her. The more money is tax-free. And Bo, might be better to put an RSP. It might be. We'd have to take a look at her tax bracket and her RSP room to see if that would be beneficial to her. But this might be a situation where RSP would be a good choice. Kind of depends. I'm going to take a look at her income next. On her T4, $36,000. She's not in a super high tax bracket. TFSAs are really nice. And Karina, the money, the mortgage interest is not reported on the slip, goes on the federal worksheet, and it goes on line 12100. Okay, so now we have a T4 slip. We have a T4E slip. She had some employment income, some employment insurance income. Homebuyer plan will not be taxable, but we have to put it on the Schedule 7 so that it's not taxable. Do you think she's going to have a refund, or do you think she's going to owe? Got $5,000 of interest income. I've got $4,000 of EI, which only had 10% taken off. Right off the bat, what do you think? We have some nice credits, but they're credits. I'm expecting her to owe unless there's something unexpected on her return. I have moving expenses, so that's good. I have a home buyer amount, that's good. I don't know if it's good enough for an extra $9,000 of income that had very little tax deducted. So we have to think about that. If we see a really big refund, we should be surprised. If we see a little bit owing or a little bit coming back, that's going to make sense. So always have a picture in your head before you start, because it's a really good way of catching your mistakes. And we all make mistakes. I make mistakes. My job is to fix them. All right, so we have Maria, and we are at 61 Trillium Court in Winnipeg, and she's in Manitoba, and she's not married. Yes and yes and no. Income, $36,325 from her T4. EI income, $41,008. Interest and other investment income, $51,006. I'm going to show you my worksheet for that one. And you're going to see interest or income earned from investments. So when you give a mortgage to someone, you are essentially investing your money in a loan product, and you're going to put it on line 7. Okay. So that's going to go on line 12100. Back to my income page. That's all of her income. Her total income is $45,539. Deductions, not a whole lot until I hit moving expenses, so we need to do our moving expenses form. Here we go. If you wanted more practice on moving expenses, we gave you more practice on moving expenses. She was 350 kilometers away from her new job. Now she's 5 kilometers away. That number is 40 or more, so we can do moving expenses. The date of the move is reasonably close to the date she started work. I don't have to worry about that. She definitely moved for a new job. She didn't have a job before. I apologize. Some of this did not get updated. She moved from Georgetown in Winnipeg or Manitoba, so I will fix that. And then Trillium Court, Winnipeg to Manitoba is her new home, and her still life will be Manitoba again. I had to do this very quickly today. I have it at home done correctly, but I'm on my work computer today. All right. Transportation and storage costs, $370 for the U-Haul. One household member in the move. If you want to claim moving expenses, at least one person has to move. So make sure you always have a number of household members. How did she move? By car, 348 kilometers at the Manitoba rate should be 17,177.48. If you got something different, let me know. One meal, she ate one meal. She can claim one meal. She didn't eat more than one. She doesn't get more than one. 23. And this is all what happened while she was traveling. Then we have the temporary. When she wasn't traveling, she was either waiting in her hometown or she was waiting in Winnipeg. Maximum of 15 days. I can do 7 nights of accommodation with the receipt. I can do 7 days worth of meals times maximum of 3 meals per day. If she ate 3 meals a day, $483. Cost of canceling the lease, $650. I cannot do the cost of buying the new home because she didn't sell an old home, so that's going to be blank. Total moving expenses, $2158.48. Okay, you got a different number. I suspect that that's because this is not updated, so let me update this. And I'm just going to fix everything. It bothers me when it is not fixed. Yeah, travel province was set to Alberta, so it is now correct. 180.96 is what it should be. Thank you. So 2161.96 total moving expenses minus the $500 reimbursement. Net moving expenses 1661.96. Hopefully you all got the same thing. Then we have to decide how much actual eligible income she had. You're going to notice it's not the same as the T4. It should be 36,160.88. How did I get that number? Well, I need to look at her T4. She had no other employment income before that. So I'm going to take her pensionable earnings. I'm going to subtract the base amount, and I'm going to multiply by 0.5%. This time we do subtract the base amount because there wasn't another job beforehand. So the correct deduction to take off is essentially the same as her eligible CPP enhanced portion. Should work out to 36,160.88. She can claim all of her moving expenses. We don't have to carry any forward. She had enough income. So I'm going to put all of her moving expenses as a deduction. And then her enhanced portion is here. Total is 1826.08. Net income 43,712.92. No additional deductions. That is also her taxable income. She's in the lowest tax bracket. So if we go back to the question of what advice would we give her with that investment, maybe not an RRSP until she's up another tax bracket, but she's pretty close. So maybe in a year or two, if she's still getting a lot of mortgage interest, maybe in a year or two, we're going to want to do a little RSP just to bump her down into the bottom tax bracket. If we do it now, all we're doing is delaying when she pays tax on it. We're not saving her any tax. So yes, Karina, I would probably suggest TFSA at this point, which is what she did. So good for her. It's not going to affect her tax return. It's not going to give her more tax refund, but it is going to be a valuable place to put the money so that it's not adding to her income for next year. All right, 13,808, personal credit plus CPP plus EI plus Canada employment amount plus the home buyer's amount, 5,000 home buyer's amount. Total credits, 22,263.78 at 15% is 3339.57, which leaves 3217.37 federal tax owing. Before I do anything else, I want to make sure I have a Schedule 7. Because she has a home buyer plan withdrawal, I have to fill this out. She hasn't put any money into her RSPs, so we're going to leave the first section blank. She has not made any contributions. Part B, Part C will be blank. Part D will be blank, but Part E we have to fill in. Part E, 35,000 came out, and if we want it to be not taxable, we have to tell the CRA that it was a home buyer plan and that she moved into the home. So there we go. It's a home buyer plan, and she's moved into the home. Right. Now we're going to do provincial. Provincial family tax benefit. Nope, she makes too much money. Personal credits. She makes too much money. But we can do her provincial tax. She's in the second tax bracket here. So the RSP would save her a tiny, tiny bit. But again, we're talking like 2%. Not really worth it. Next time she's up one more tax bracket, it probably will. Okay, personal credit, CPP, EI. Notice there's no Canada amount, there's no homebuyer amount provincially. So she's not going to get any additional provincial credits. Her total provincial credits is 12,134.78. 10.8% is 1,310.56. We're going to use that to reduce her taxes. Provincial tax at the end of the day is 3,605.23. Goes back to the bottom of the return. Total tax she should have paid this year, $6,822.60. Total tax deducted was less than that. Remember I said I'm thinking she's probably going to owe, even with the moving expenses and the home buyer amount. That's a lot of income to add to the return that's not taxed at the rate it should be. So we have a balance owing of $931.80, which I was expecting to see. She is still going to get climate action incentive, which will pay a chunk of that if she wants to wait. And about if she puts some money into the RSP, would it make her not owing? Probably. In fact, we can check that. How much would you like for her to put into her RSP if she had done it? So let's say she came to us in February and she still has time to make a contribution. What would you like to see? Pick a number. If she has RSP room, I'm going to assume she has RSP room. Let's say 2,000. So I'm going to go in here, and I'll be teaching you how to do this data entry later. One of the reasons why I'm using the program and not fillable forms is so that I can make quick changes like this and get things in and out very quickly. So I'm going to assume that she has some room. Make sure I have enough, and I'm going to put some money in. And I'm going to assume that we're going to do 2,000 now. Oop, that should say test so that I can track it. That's going to change it, but not enough, but by quite a bit. What it would look like on the return if I did that is now I'm going to have a contribution in the first part of the year of 2,000. And I'm going to have RSP room. I can actually use the deduction if I want to. And then if I do apply that deduction, it's going to change all of the numbers on the tax return that come after the fourth page, which is basically all the numbers on the tax return. And it would give her still a balance owing, but a lot less. Still might not be the best solution, though, because all I'm doing is delaying when she pays the tax. I'm not making it not taxable permanently. But I could, if my client wanted to see that, if that's what she wanted to do, I could put that in. I could say, what if I bump it up to $3,000? She could go in, she could put in a $3,000 deduction. I've almost wiped it out. Put a little bit more and it will, and then she'll get zero back. Might not be the way to go, though, because that money sitting in a TFSA is valuable. Remember, it's growing in the TFSA. She has the savings in the TFSA. She can use a bit of her TFSA to pay the tax owing if she wants to. So she has some money there waiting for her if she needs it. That might be a better option for her at this point. All right, I'm going to take all that out so that I don't forget to. And let's get back to the original, which is a nice balance owing. What are some other things she could be doing with that mortgage interest money if she wants to that would affect her tax return? So maybe we can't give her a deduction, but what could we give her? We could donate. Political contributions are great. I've made too many changes too fast and my computer doesn't like it. Let's try one more time. Not be able to get this one back again. Aha, there we go. 931.80. She could invest in her education, go back to school, get a nice refundable credit based on her age from the Canada Learning Plan, the new thing that they have. We'll talk about that when we get to students. So there are things she could do there. All right, we're going to stop. We'll do the last one next time because we've gone a little bit over. Have a really good day. The next chapter is hard. Please read it in detail. Take some time with it. It's very, very complicated. There are a lot of rules. Make sure you do your self-test. Self-test number 3. We'll take it up at the beginning of next class. And I will see everybody next week.